So I just bought more shares of 3M Company, ticker symbol MMM, added to my position this morning. The stock is down. I'm excited to average in because I started buying this dividend stock in 2018 and I'm still accumulating my position. I'm building my position. It's going to take some time to reach the full size of this position in my stock portfolio. So I'm excited for this buying opportunity. And I want to discuss 3M in today's video. Also, 2 other stocks that I just recently purchased and 3 that are on my watch list right now. The market is starting to correct. There's some volatility out there, and I'm really excited for these buying opportunities. So let's talk about dividend stocks. So people often ask me, hey Ian, which stocks are you buying right now? And so 3 stocks that I'm buying right now are 3M, PepsiCo, and IBM. So 3M, these guys make so many products. Here is actually the blue painter's tape that they make. I love this tape. I use this tape all the time when I'm doing projects around the house. And surely there are knockoff brands, there are other brands that make this painter's tape, but I don't know if you can see it here, I always buy 3M. I always want to buy the best possible painter's tape because I don't want this stuff peeling the paint off of the wall. I want it to be the best possible one. And I know when I go with 3M, I always get the best quality. So I love these guys. I love 3M. Anyways, I've wanted to buy 3M for a long time, but it always seemed too expensive. It always seemed like this stock would never go on sale. And so I started averaging in earlier this year in 2018. And today, just this morning, a gift presented itself. And I often save a little bit of dry powder so that I can buy dividend stocks when they go on sale. And it happened this morning. 3M stock started plunging. And the reason that it was plunging is they had a lackluster earnings report that did not meet the expectations of the analysts. I love it. These analysts always create buying opportunities. That's why I like these guys so much. Anyways, what happened is revenue is down year over year, 0.2%. 0.2% revenue is down. Net income was up 8%, and they lowered their guidance. So their guidance for the year was down. Analysts were really upset about this. The market took this news very poorly, and the stock started plummeting. At one point this morning, I think it was down around 8%. I was able to get in around $190 per share. It's gone up a little bit since then. It was down in the 180s earlier. And so it was exciting to see some volatility here in 3M. The stock is lower than where I originally purchased it, but I like that because this position is still really small in my portfolio. I have a long way to go to accumulate my entire 3M position. So I'm okay. I don't mind the share price going down. In fact, I like it. I look at these as opportunities, as literally a gift. And so if I take their dividend of $5.44 per share, I divide by the share price of $190, which is where I bought earlier today. My starting yield is 2.86%. This is not very high. This isn't a very exciting starting yield. This is one of the lower current yields of any stock in my overall portfolio, but 3M is the kind of company that is so well diversified. It has such a track record. It typically trades at a premium. And the dividend growth rate is really high with this company. And so whereas the starting yield may not be very high, if I hold this stock for many years, the compounding effect of dividend growth will surely get me to a really awesome yield on cost. So I love these guys. And worth noting, this is an industrial company. They make a lot of industrial parts and adhesives and products, and this is a company that's not going to just go straight up and to the right. There's going to be some volatility in there. In the business cycle, this is an industrial. They're going to face some challenges with the B2B business cycle. We know the overall economy, it doesn't just go up and to the right. There are cycles. It has ups and downs. And so anyone expecting this thing just to go straight up, it's just not reality, especially with a company like this. But I love these kind of opportunities. I like the fact that they're hitting some softness. Maybe the dividend growth rate in the future for the next year or two might be a little bit lower, might be a little bit slower because of some of this softness. I'm okay with that because I'm in this for decades upon decades. I'm in it forever. And so I just like the opportunity to buy in at this price. So I'd be curious if other people out there, I know a lot of investors in the community, Dividend investors, I know a lot of you guys love 3M. A lot of you guys, it ranks in your like top five stocks in your portfolio. And so I'd be curious, are you adding here? Do you think it's on sale yet? Are you waiting for lower prices? I hope it goes down more, but to be honest, 3M, it's so rare to see any kind of sale that I just jumped on this. Yeah, starting yield of 2.86, not that exciting. I'd feel a lot better if I were buying at like 3% or more. 3.5% starting yield, I'd start feeling like this thing is really getting to be more in value territory. So I still look at it as kind of expensive. That being said, it's rare to see any kind of correction with this thing. So I bought some more. I'm excited. I hope to buy more shares later this year. Hope for more opportunities. So I also recently purchased Pepsi. By the way, these are stocks literally that I'm purchasing now in October of 2018. So these are stocks that I'm actively buying right now. Pepsi. Pepsi is an interesting one. I've covered this a lot on my channel. It's my number 2 favorite stock of all time. I'll link in the description below. And the reason that I added to Pepsi, I don't know if it's at a really great discount or anything now. In fact, earlier this year, I bought shares of Pepsi at a lower share price. That being said, right now it's at 109. The 52-week range has been between 95 and 122. So it's kind of in the middle. It's not a great value now. It's not at a discount. But the reason that I bought Pepsi is it's at a reasonable entry yield. The starting yield, I take the $371 per year that they're paying in dividends. They pay it quarterly. Divide by the current price of 109. I get a 3.4% starting yield. Reasonable starting yield for Pepsi, but the real reason I bought more is I'm just trying to bring it to size. Right now, Pepsi represents 4.5% of my portfolio by equity value, by just the dollar value of the shares that I own. By contrast, my number 1 favorite stock of all time, I'll link in the description below, Johnson & Johnson, that one represents 8%. J&J is 8% of my portfolio. Pepsi's number 2, and it's not a very distant number 2. It's a close number 2. I really like this company. It's a close number 2 to my J&J. I'd like to see this representing at least 7% of my portfolio, and so being at 4.5, I just know I need to keep adding more. I recently did a video on my top 5 stocks of all time. I'll link in the description below. The reason I'm ranking my top 5 stocks is to remind myself, hey, Ian, you need to bring these to size. You need to prioritize these. You need to get these to the representative size in your portfolio by dollar value of your position. And Pepsi, it's good at 4.5%, not bad, but I really want to see it up there closer to 7%. So that whole video series I did, it wasn't just for everyone out there, although I surely is sharing my journey here and I hope it benefits everyone, but I also did it for myself to remind myself, hey, Ian, these are your top 5. You got to focus. They may not always be on sale. Out of my top 5, I would say right now the most reasonable value probably is Pepsi. The other ones seem a little bit more expensive right now. So I'm going for it. I'm adding some more Pepsi to bring it up to size in my portfolio. So I'm really excited about that dividend stock and just my number 2 favorite company of all time. Moving on. IBM. So I've spoken a lot about IBM recently. This is a smaller position in my portfolio. It's less than 2%, and it's going to stay there. It's not going to be a very big position in my portfolio. It's my only pure play tech stock that I own. I will link in the description below to my recent IBM video. I've done a few videos on it actually, so I don't want to spend too much time on this topic, but it's trading at 130 per share. The starting yield is a 4.8%, and what's most exciting right now is the PE ratio is under 10. So this stock had a revenue decline year over year. It is really, the analysts really don't like it. I love these analysts because whenever they don't like something, it creates an opportunity. The analysts are unhappy. Boy, I like it when they're unhappy. Anyways, this is a riskier position. This is a position, these first two, very, very lower risk buys in my opinion. IBM, potentially some risk there. I'm willing to limit my position size to cap the risk, and I see it as a deep value play. These aren't really value or deep value or anything. Maybe 3M, and they're kind of like roughly value. They're not even values at this point, but reasonable entry points. I look at IBM as kind of like a value or deep value type of entry point at this point with a PE under 10, and I'm excited. I think there's a lot of long-term opportunity there. I think in the next 5 years there's probably not as much opportunity, but I think long term for someone with a long-term game plan like myself, a lot of opportunity there for some serious cash flow, serious dividends that I can use to pay the bills. And so these are 3 stocks that I'm literally just bought right now, right this minute, pretty much in October of 2018. So you may be wondering, hey, Ian, which stocks are on your watch list? What are you kind of watching right now? And it's funny, my strategy is always evolving. I'm learning. One of the reasons I have this community is I'm learning just from all the conversation. I'm picking up ideas, and sometimes just through conversation, I'm coming up with new ideas I wouldn't have come up with otherwise. And so one of these investment ideas is Ford. I did a video on Ford. I'll link in the description below. You guys have been asking me, Ian, have you revisited Ford since your video? Because it's dropped a bunch. It's at $8 and some odd cents per share, 8.595. So Ford is trading at a discount, and the starting yield is 8.4%. Their dividend yield is weird because they pay, the dividend on Yahoo Finance looked incorrect to me. The way I calculate it is I look at their dividend history. 3 of the dividends out of the year are 15 cents, and then the 4th one is typically like a wild card amount based probably on their performance. It was it was 28 cents last time. So I add up 15, 15, 15, and 28, and I divide by the 8.595. I get a starting yield of 8.4%. This is an interesting thing here. This is interesting starting yield. So worth noting, at the trough of the Great Recession, Ford was trading at $2 a share. So it's at over $8 now. So yeah, it's come down from the highs, but look guys, it's up from $2 to $8. It's still way up. And so I am not comfortable buying Ford here. I am not comfortable, quite frankly, because I don't understand the company as much as I would like to. I have a lot more analysis I'd like to do. The thing I look at Ford is long term, I think it's a cyclical company. I don't really see the share price going way up. I don't really see the dividend growing that much more than it is now either. However, if I can lock in a starting yield of 10% or more that is somewhat locked in, that I feel comfortable with, and like I said, I have a lot more analysis to do here, I may consider buying some shares just from a pure, like, hey, I'm getting 10% yield, I'll buy and hold forever for that 10% yield. Bring some current cash flow into my portfolio that if I want to, I can start using to pay bills right away, although I'm not at that point yet. But I like having current cash flow because it gives me even more flexibility. These ones like 3M, Pepsi, even IBM to a sense. IBM's kind of in the middle, but 3M and Pepsi, that's future cash flow. I'm not going to be paying too many bills on my 2.8% starting yield on 3M. But if my yield on cost gets up, 10% or more over time by holding this thing, enjoying dividend increases, then we're talking some serious cash flow. That's really good cash flow. But at a starting yield basis, not getting me anywhere. By contrast, at Ford, right now at a starting yield of 8.4%, that's some serious starting yield. It doesn't have to grow too much from there. 8.4 doesn't quite do it for me. If it gets over 10 or more, that's when I really start looking at this thing. But I'm going to start looking at it even before then because I want to understand how safe is the dividend, how strong is the business, how well positioned are they. I think we're going to be headed for some tough times in the future. We're in the late stages of this bull market, of this economy. At some point, there's going to be a correction. When the correction comes, companies like Ford are the ones that are going to get hit first because businesses, they have a choice. They don't have to purchase new cars. They don't have to upgrade their fleet of trucks, for example. They can wait until times are better. So this is the kind of thing that tends to be cyclical, and it's going down already. And I think the reason it's probably starting to go down is cyclical companies, I'm seeing this with other companies right now, are starting to anticipate what's to come. They're starting to anticipate the business cycle. And so it's something that I really want to watch closely. I would have never thought that I would be looking at this company so seriously, but there's just something so compelling about a 10% yield if I can get that, and I feel that it's stable. Now, worth noting, people who bought at $2, they're yielding 36.5% yield on cost right now. The beauty of that is it really doesn't have to grow the dividend. It really doesn't have to, company doesn't have to do any better. Even at 10%, that's the way I look at it. I look at it as just buy and hold for the 10%. And so this is a different type of dividend stock. Would it be a core stock for me? No. Would it be a medium stock? No. It'd be a smaller position, but locking in that 10%, It's a different type of dividend investing. It's a different mentality. It's different than the pure dividend growth investing mentality. So it's just a little different. And for that reason, I wanted to point it out on the video today. I'd be curious how many people look at it that way. Do you look at this as a dividend growth stock, or do you look at it more like me, that you're kind of like locking in a big yield and doing your research and hopefully proving to yourself that that yield is somewhat safe over the long run? Surely there might be interruptions during horrible business cycles, but more or less the 10% during a normal business cycle is going to be there. I'd be curious how many people look at it that way versus look at it more the traditional dividend growth way. I surely don't look at this as a dividend growth stock. I look at it as a locking in a high yield stock. So I'd be curious. Next one I'm looking at right now is Cedar Fair. Cedar Fair, ticker symbol FUN. This is a stock that I started purchasing in 2018. It's been hovering around my purchase price, which is a 6.8% yield. This is an amusement park company. I'll link in the description below. I would actually probably be buying more today if I had more funds to invest. I just don't, because I just recently made purchases in 3M, Pepsi, and IBM. And so I'm kind of saving up my money again, and once it makes sense to make my next purchase, it may be in Cedar Fair, because I just like the company at these levels, and I like locking in this 6.8% starting yield that's actually growing over time as well. It's a slower growth, but it's growing. I like the fact that it's somewhat of a real estate company. It's an amusement park company that owns a lot of real estate, and I like that element about it. And worth noting, it is a master limited partnership, so it does make taxes a little more confusing. I'll link in the description below to my Cedar Fair video, so you can learn more all about the fun over at Cedar Fair. But I'm watching that one closely, and like I said, if I wish I was buying 4 stocks right now, but I use the money I have to invest across these 3. So I'm just watching it. I'm hoping that the price stays low, but I surely am happy that I already brought it up more or less to size. I put a reasonable amount of money in the company when I first got started with the company, because I knew, being a master limited partnership with the tax stuff, it has to be at a certain scale in the portfolio to make the tax consequences, the tax reporting, the K1s and such, all worth it to me. So I already put a good chunk in, and that said, I'd love to own more. So the last stock that I'm watching now, a lot of you have been asking me about this, is AbbVie, ticker symbol ABBV. I'll link in the description below. Recently did a video about that one. I said in the video, hey, I'm not buying this thing. There's some concerns I have with it, with the dependence on Humira, with the kind of the single drug dependence of this company. That being said, it's starting to fall down. And what I said in the video is, look, if this thing kind of gets around a 7% starting yield, I'll probably take a more serious look at it. Well, starting yield now is 4.6%. So it has a way to go, but the share price has been falling. And if it continues, if the market maybe faces some weakness, you never know what will happen. I probably won't get my 7%, but it may. You just never know. The market could face some weakness. This company could face some weakness. So it's on my watch list. If it hits a 7% starting yield, I would like more exposure to healthcare in general. I got big exposure, though, through J&J at 8% of my portfolio. So I'm not, and I've got Pfizer, quite frankly, which has done really well. Ticker symbol PFE. That being said, I would like to own some AbbVie at the right price that compensates me for the risk that I'm taking on with their dependence on Humira. So those are the 3 stocks that I'm watching right now, and we'll see. Out of the 3, quite frankly, the one I'm most likely to do is Cedar Fair, just because I like adding to existing positions. I like to stay focused. I have 38 stocks. Do I really want to add number 39 and 40? It's just going to be too many. And so I'm only going to do that if there's a really good reason to do it. Otherwise, I'm going to do what I'm doing here, is add to what I've got when the opportunities present themselves. But I love a good buying opportunity. So a few things before we leave today. In terms of full disclosure, I am long. I own the companies that I mentioned today. I am long. I own shares in my personal portfolio of 3M, ticker MMM, PepsiCo, ticker symbol PEP, Johnson & Johnson, ticker symbol J&J, Pfizer, ticker symbol PFE, IBM, ticker symbol IBM, and Cedar Fair, ticker symbol FUN. I own those stocks in my personal stock portfolio. Also, just a fun tidbit today. I got the cardboard today. I don't even have paper on here. People ask me, Ian, your audio's not that good. Hey, at some point, maybe I'll upgrade my equipment. But The reason for this, quite frankly, is philosophically, as a dividend investor, it's important to save money. And every dollar that I can save, I can invest in dividend stocks. And so look, this video may not be the prettiest video. It's got the cardboard here. I don't even have the whiteboard. Well, Ian, what are you doing? Can you just buy a new one? Well, these boards are actually not cheap. And look, this saves a piece of paper. I get use out of the cardboard. It's better for the environment to actually use that cardboard. Why not? Why not do that to save a few dollars? And so this is just philosophically the way I try to think. Look, I haven't always been good at saving money. I haven't always been the best at saving. I've always been good at investing, more or less, but saving money, hey, I have a lot to learn, but this is just one small way I can do that. And so I encourage all of you out there to think of these small ways. What are some small ways you can save money? Same thing with the microphone. Hey, microphone I've got gets the job done. For a while there, it was broken. Now I've kind of fixed it, so it's kind of working. And yeah, the audio quality could be better, but at some point I'll probably do that. But right now, you know, things are going all right. And I'm a dividend investor, so this is my persona. This is what it's all about to be a dividend investor. It's about being frugal when you can so that you have more money to invest in companies like 3M and the others mentioned today. Every dollar makes a difference when it comes to getting early financial freedom and massive cash flow from dividends. So another thing, we're gonna have a meetup really soon. I'll link in the description below. Sign up for the local crew list. I'm gonna have a meetup at the Starbucks Reserve. In terms of full disclosure, I am long on Starbucks, ticker symbol SBUX. I own that stock in my portfolio. We're going to meet there, Starbucks Reserve in San Francisco, talk about dividend stocks. So last chance, sign up below. I'm going to be choosing the date literally within the next 2-3 days, and then I'm going to be emailing everyone on the list the date, the location, the time. Everyone will have that on their calendar. Can't wait to meet you guys. By the way, I am so grateful, so thankful for your support. It truly means the world to me. We are doing so well here at PPC Ian. We're over 15,000 subscribers. I'm getting a lot of you going over to my Instagram channel as well. I will link in the description below. Please check me out on Instagram. I'm sharing some really cool investment insights and other life insights over there. Good stuff on Instagram. And if you appreciate this channel, you appreciate this community, the best way you can support myself, the community, is to subscribe, comment, like the videos. It really means the world to me. Thank you, thank you. And before we leave today, in terms of a disclaimer, friendly disclaimer, I am not a licensed investment advisor. Today's video is not investment advice. This video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. And literally just sharing my journey for fun and entertainment here on YouTube. By the way, I was out and about the other day. Someone ran into me, a subscriber said, "Hey Ian," and introduced himself. It was so much fun. This was Sean. We ended up having lunch last week. I shared our story on Instagram, so check that out. Link in the description below. But if you ever see me out there, please reach out. I love meeting subscribers. I love meeting dividend investors. Let's connect. Let's chat about our passion for cash flow. And maybe we go to lunch or grab coffee. I really enjoy that stuff. So thank you, Sean, for reaching out, and I look forward to meeting more of you guys as well. Hey, everyone, I will let you go. Once again, go 3M, and I will see you all in the next dividend investing video.